All right, so you're hearing that note from Wells Fargo. They're seeing a potential correction going back to those November lows, but you're actually keeping your eye on the December lows and the fact that we haven't returned to those. What do the technicals tell us about the December lows as opposed to the November lows?
Yeah, Frank. I mean, we've been talking about for this entire year a hop, a drop, and a pop. And at this point in time, we still think we're in this sort of hop phase. We continue to think that the market could trade up toward about 42, 4,300 on the S&P 500. And yeah, we would agree with the Wells Fargo strategist that there can be a drop, but that drop will most likely come when the Fed starts to cut rates. And if you look out at world interest rate probabilities, Frank, that suggests that that could start to happen mid this year or perhaps in the third quarter of this year.
All right, so Craig, break this one down for me. We're still in the hop right now. You're sure we're still in the hop? Because I'm looking month to date. The S&P's flat, down like 0.1%. The NASDAQ, however, is down more than 1%. So if this is the hop, why aren't we seeing stocks continuing to rise in the second quarter?
Well, Frank, when you go back and you just step back and you look at the chart going back over the past 24 months in here, you'll see that there's great downtrend reversals that have already occurred on both the Dow, the S&P, the NASDAQ, the Russell, and even the Dow Transport Index. And you're starting to see that you got a series of higher highs and higher lows that have been made. And Frank, I'd also just come back and point out that when you look at the lows that were made last September and October, that's when we saw the largest number of stocks get extremely oversold on a very simple momentum indicator. And in the recent correction that we had seen earlier this year, we never even got back to those sort of oversold levels. And then, Frank, the other thing I'll just mention is if you come back and you look at history all the way back to 1929, when you look at the fact that we haven't seen in the first quarter a break below the December lows of last year, that has historically been a pretty bullish sign for the market. In fact, when you look back in time, the market is typically 83% of the time is higher with about a 13.7% annual return when you don't break back below those December lows in the first quarter of the new year. And that's exactly what we've seen happen this year. And again, while we might get a pullback or a correction, I think we got to keep our eye on the long term for the entire year. And we still think we can get to 46.25. And in fact, Frank, if you look at some of the underlying indices, clearly, it is trend lines over headlines at this point in time. Because like you mentioned, and like that other strategists had pointed out, all the negativity out there at this point in time, stocks aren't going down. They're starting to trend higher. And we really need to pay attention to that fact.
All right, I like a good turn of a phrase, Craig. I like trend lines over headlines. Great stuff. But I'm going to have to ask you about this one. How do we get to 46.25 from here? You're saying we're in the hop. We're still waiting for the drop. 46.25 is about an 11% upside.
Yeah, it's about 11% upside. How do we get there? I think once we are actually declared that we're in a recession, which could happen in the second half of this year, certainly aligns with the house view here at Piper that we could see this happen sometime later this year. But when you're actually declared you're in a recession, Frank, history shows that you typically backdate that recession start date by about 7.6 months. And you also at that point in time have found throughout history that only one time since 1929 did the market in terms of equities being the S&P 500, not bottom while you're in that recessionary period. And that was 2002. So I think the odds are that you'll get a pretty healthy rally once the market is officially declared in a recession by NBER, which again could happen later this year.
So when's the drop happen? The drop happens in the third quarter before the pop, because you got to have the pop to end the year at that 46.25, right?
Yeah, we definitely will see that. Again, coming back to thinking about what the world interest rate probabilities are telling us at this point in time. When the Fed starts to cut, that could be somewhere around the July meeting, could be a meeting after that, somewhere in there. But we're setting ourselves up for that quick drop. I think that is going to get bought. When you go out and you look at positioning data right now, when you look at the E-mini futures contracts, Frank, we're at levels right now that we have seen only at the lows of the market in 2020. 2011 and 2007, the world is already very negatively positioned, and any drop will get bought from our perspective.
Right, that might be the world, but right now, I want to go to what you're talking about. You're currently overweight on energy, industrials, and tech. You have your technical opportunities portfolio. You made some ads, including a number of stocks that made some huge run-ups this year, including Meta, marketing software maker HubSpot, and then connectivity company IAMG, ticker PI. I can't even pronounce it. Just really quickly, do you see tech continuing to rally until when? When does tech see that drop?
Well, at this point in time, people are coming back to tech the way the 10-year bond yields have come back in here as of late. And as you go through and you just look at the charts across the board, we're seeing a huge number of downtrend reversals on the charts. Yes, there's a lot of skepticism out there at this point in time, Frank, but stocks are a really pretty good leading indicator for the market.
Okay.
And right now, you're seeing tech turning higher, and you're seeing more of the offensive names turning higher.
All
Even
right.
stocks like Regeneron and biotech land are turning higher too.